This video contains a structured approach to help you design a trading strategy tailored to your goals, risk tolerance, and time commitment. I will be using the Moving Average Convergence Divergence Indicator, MACD for short, as an example to help you get a clear idea about how you can develop your own strategy. First, let's define the objectives and constraints. There are two categories under this part. The first one is the time horizon. So, are you scalping, day trading, swing trading, or investing for the long term? Your time horizon will significantly affect the tools and methods you use. So in this example, I want to be scalping with the MACD indicator using the 15 minutes time frame. Then we move to the capital. You need to define how much capital you have available for trading and how you intend to allocate it. I'll be using $500 as starting capital in this example. Now we move to our second section, which is choosing your market and asset. This is the part where you decide which markets you want to trade, being it stocks, forex, commodities, crypto, or any other. I recommend you choose the assets you're most comfortable with or have the most knowledge about. Understand the volatility, liquidity, and trading hours of the assets to make informed decisions. I'll be using the forex market in this example. Developing a methodology. This section is the foundation of your strategy. You're either choosing A. Technical analysis, which involves studying historical price charts and indicators like moving averages, RSI, MACD, etc., to identify patterns and signals. B. Fundamental analysis, which includes analyzing financial statements, earnings reports, economic data, or news events to make trading decisions based on the intrinsic value of an asset. Or C. Quantitative analysis, which involves developing algorithms based on statistical analysis using factors like price data, volume, and volatility can be another approach. I'll be using technical analysis for my strategy. After that, we move to our fourth section. Selecting indicators, concepts, and tools. So for technical analysis, you need to select a set of indicators that align with your strategy. Some commonly used indicators include moving averages, like the SMA and EMA, which are trend-following indicators that help smooth price data. Then we have the Relative Strength Index, RSI, which is a momentum oscillator that measures overbought or oversold conditions. Then the Bollinger Bands, which is an indicator that shows volatility and potential price extremes. And the MACD, a trend-following momentum indicator showing the relationship between two moving averages, and many others. Apart from using indicators, you can opt for the use of chart patterns, in which you try to spot and trade common chart patterns like head and shoulders, triangles, flags, and others. You can also make use of support and resistance, which involves strong historical price areas of interest. And you can also use other trading concepts that have already been established, like the smart money concept. It all depends on preference and how you want to approach the market. As already stated, I'll be using the MACD indicator in this video. Now onto our next step, which is to establish entry and exit rules. After selecting your trading concept or indicator, you have to establish entry and exit rules. With entry conditions, you define what conditions need to be met before entering a trade. This could involve a combination of price action, technical indicators, or news events. My entry condition using the MACD will be when the MACD line and the signal line cross. If it crosses above the histogram, I will sell. If it crosses below the histogram, I will buy. If it crosses just at the histogram and not above or below it, I won't trade. With the exit conditions, you establish clear exit rules. This could be based on price levels, the crossing of indicators, a change in market sentiment, or just allowing the trade to hit target profit or stop loss. My exit condition will only be when the trade hits the stop loss or target profit. I will allow the trade to go on until price touches one of them. Note that you should be ready to adjust your rules as market conditions change, or you identify more effective strategies through experience. From there, we move to our next section, which is risk management. Under risk management, we have to set some rules for ourselves so that we can protect our account effectively. We start with the position sizing, where we determine how much of our portfolio we will risk on each trade. A common rule is to risk no more than 1 to 2% of your total capital on any single trade, and that's what I'm going to do. I will be risking 2% of my $500 capital, which is $10. Now, with the stop loss and take profit, we set clear stop loss to limit losses and take profit levels to lock in gains for each trade. My target profit will be the next resistance or support area, and my stop loss will be just 20 pips. Risk-to-reward ratio. A good rule is to aim for a risk-to-reward ratio of at least 1:2. This means you're willing to risk $1 to potentially earn $2. But in my case, I will be using a risk-to-reward ratio of 1:1. However, after establishing the 1:1 risk-to-reward ratio, if my target profit, which is the next support or resistance area, is more than the one for the reward, I will increase my reward to reach that support or resistance area. So now that you have the time horizon, the capital, your risk management, the market to trade from, the methodology, and your trading indicator or trading concept, you move to the next phase, which is backtesting your strategy. This is where you put your strategy to test to assess its weaknesses and strengths. The very first step is the historical testing. This is where you backtest your strategy using historical data to see how it would have performed in the past. Ensure whether or not the strategy works across different market conditions, being it a bullish, bearish, sideways market. The other is simulation, where you use trading simulators or demo accounts to paper trade and test your strategy in real time without risking money. After backtesting, you make adjustments. During backtesting, you might realize that certain parameters need adjustments. Some days may not be suitable for that strategy. Some opening and closing sessions may also not be suitable. Some candlestick patterns will be stronger than others. Be patient and tweak as necessary. After 1 month of backtesting my strategy, I realized that it's best not to trade after the close of the London session on Fridays. Even before a big news event like the Fed's interest rate, if I'm presented with an opportunity, I should enter the market. After hitting target profit in a trade, the next crossing that occurs shouldn't be traded until the second crossing. In total, I lost 120 pips and gained 826 pips. Using a lot size of 0.05 and risking $10 per trade, I lost $60 and gained $413. In total, I had $853, with $353 being the profit, gaining 70% of my capital in 1 month. Now, after backtesting and making some adjustments, you need to monitor performance and adapt. You should keep track of your trades' performance metrics such as win rate, average profit, drawdown, etc., and continuously refine your strategy based on results. You should slow document your trades, including the reasoning behind each trade, the outcome, and any lessons learned. This helps identify patterns in your trading behavior and improves decision-making. And lastly, you should regularly review and analyze your strategy's performance. If it's not meeting your expectations, adjust your methodology, risk management, or tools. Another key step is you need to stay disciplined. Stick to your strategy even in the face of losses. Emotional decisions can lead to unnecessary risks and losses. Avoid chasing losses or changing your strategy impulsively. Consistency and discipline are key to long-term success. Then you must have the mindset of continuous learning. Keep updating your knowledge on trading strategies, market conditions, and new tools. The market is constantly evolving, so successful traders adapt by learning from mistakes and staying informed. If you enjoyed this video and you would like to have more insights on trading, don't forget to like, subscribe, and comment. Have a great trading week.